So, folks, we are going to spend half an hour talking with Waikit Lau, who is a very, very, very experienced investor, advisor, and also operator from the industry with a very special expertise in artificial intelligence. Waikit, welcome to the show, and I'm thrilled to have a fellow MIT alum on the call.
Great. Well, so I apologize for the technical difficulties. Thanks for having me. Excited to be here.
So tell us a little bit about what you've been up to so our audience gets to know you and your background, and then we'll get to what kind of things are you investing into at this point.
Yeah, no, absolutely. So very quickly, I'll just give you my background. I'm trained as an engineer, MIT back in the mid-90s. The last 20 years mostly have been in technology. I kind of call myself having a checkered background because I've done pretty much a lot of very different roles in technology. I've started 3 companies. 2 of them got acquired, and I helped take one public back in 2013. I've also spent some time in big tech companies at Cisco. I was part of the Scientific Atlanta group, the IP set-top boxes about 13 years ago. I also spent some time as an investor at Bessemer Venture Partners, again, about 12, 13 years ago. The last thing I did was, so the last company I started was about 10 years ago. It was a company called ScanScout. We applied machine learning to understanding video. So we started around the same time as YouTube, and our thesis was video behaves very differently in search and in ad matching than web pages. So as we suspect video will become popular, this is back in 2005, 2006, you're going to have the same 2 problems, which is you have a search problem, a discovery problem, and then you have a monetization problem. So we basically built a platform that uses machine learning to understand what a video is, and then based on that, be able to inject an appropriate ad, a contextual ad, into the video. So very similar to what AdSense for video would have been. So anyway, we did that. It got acquired in 2010, and then we helped take the acquirer public in 2013. And then in the last few years, been mostly advising, investing in companies. I've started a machine learning, a deep learning community that's grown to about 150,000 people now. And yeah, so that's kind of where we're spending time.
So, Waikit, you missed the early part of this session. This is the world's largest virtual accelerator. Global virtual accelerator. We have entrepreneurs from all around the world who participate in this forum, and we have a community of 500,000 people. So either they're entrepreneurs or aspiring entrepreneurs or technology industry people. So what I'm going to try to do in the next few minutes is to help our entrepreneurs who are working in your domain understand how you think about investments, how you invest, what you invest in, what your investment thesis is, and where do you think great companies are going to be built in this next generation. So let's start by, addressing what you like to invest in, domain-wise and stage-wise.
Yeah, the stage-wise is easy. I find myself most helpful usually very early stages. So anywhere from literally 2 guys with an idea on the napkin, no product, no demos, all the way to basically a classical Series A, right? Product out, maybe some revenues. So early stage is kind of where my focus is. And then in terms of domain, I really don't. I think unlike a lot of investors, I look at everything with the exception of pharma or biotech because I have zero knowledge there. But I have invested in all the way from chips, semiconductor, to software applications, right? And to blockchain-related companies, crypto-related companies. I think to me, it matters less about the domain. I think it's really about the team, the problem, and basically the team and the problems, right? Is it a big enough problem? Is it a problem worth solving? And then is this the right team? Is this the right people to tackle it?
And what about geography? You are based in Boston, right?
Yes, yes.
Do you invest only in the Boston area, or?
No, I don't. So I limit my focus on. So I invest anywhere in the U.S. I've done deals. So over the last 10 years, I've invested in about maybe 50 to 60 companies. And they're all over the place, but they're all in the U.S. They're all in the U.S. Primarily.
Okay. And your average check size is?
It ranges anywhere from 25,000 to 50,000.
Okay. And let's talk a little bit about how you operate. So if you put in a 25 to 50K, do you operate with a syndicate that would bring in the rest? Do you lead a syndicate, or do you follow into a syndicate? How do you manage all these? You've invested in 50 companies as a personal investor. What is the process?
Yeah, no. So it really depends on what the entrepreneur wants and needs, right? So it ranges from on one end of the spectrum, they may say, hey, I've got no connections. I'm new to this, but I've got something really interesting. So I essentially help them either put together a syndicate where I run the syndicate, or I introduce them to potential lead investors that I think would gel with them personality-wise and understand what they're trying to build. So I also, in a lot of cases, entrepreneurs already have the syndicate set, or they have a lead investor, in which case I'm just a follower. I'll just write a check for myself. In the cases where I've actually either led or co-led, it runs the gamut, right? I have a angel list syndicate where I've done deals where I, run a few $100,000. I run a syndicate that's a few $100,000. Or I have also done it outside of angel list syndicate because, some entrepreneurs say, hey, I don't really want to do angel list. I'd rather do it outside of angel list. And, I think it's, I just basically say, whatever you want, I can be helpful.
Okay. Now, what we try to do here is work on a lot of case studies. So before you came in, we were doing basically pitches where we were strategizing on a couple of companies, and people get to listen to how to think about different problems. So in your portfolio, in all the 50 companies that you've invested in, could you take us through a couple of case studies and explain what was the idea that came to you, what stage it came to you at, and what was it that really struck you that this is going to be powerful, this is going to be a high potential technology and business opportunity that got you to invest?
Yeah, no, absolutely. I can give you a couple of examples on sort of various stages and feel, in no particular order. So I'll say the first one, it would be that I think is an interesting case study is a company out of MIT, spin out. It's 4 MIT alums. They were students a few years ago. I met them. I was mentoring them. They then got into Y Combinator. The company is called Multiply Labs. This is what they're doing, which is very interesting. So they have figured out a way using off-the-shelf 3D printers to print, and they modified the printer to print pills using FDA-approved polymer, right? So what they can do is they can print a pill with different pockets in the pill. So you can actually have different ingredients in the pill and have different wall thickness of the pill, so it actually have different release schedules, right? So it's really interesting. No one has done this before, and essentially what they've built using that platform is an assembly line to 3D print at volume pills. They're starting off with dietary supplements. Obviously, where this becomes huge is pharma applications, right?
Insulin and all that, yeah.
Exactly. So now it takes a long time, right, to go through the pharma process. So the dietary supplement piece is sort of the low-hanging fruit and kind of where they're focused on to get the scale and prove that this works. So in that case, when I saw them, I was mentoring them. I thought this is really interesting, and then they got into Y Combinator. This is one of those cases where I was a follow-on investor. Right. And when they had lead, I said, I'm in. I love what you guys are doing. I think it's a big problem, and more importantly, they are the right team to solve it. It's essentially 2 PhDs in mechanical engineering and pharmacology, and then they had 2 Sloan MBAs out of that as well. So that's kind of the 4-person core team. It was a well-rounded team. So that's one example. Another example is a company called Swirls. It is, I got introduced, and this is one of those cases where, like 2-3 degrees of separation. I got introduced to them by an ex-board member of mine from the last company. And when they came to me, it was literally 2 guys with a white paper, right? They have some demos, some code, okay. And this is in the crypto space. They've essentially invented a better mousetrap for consensus algorithm, right? So you look at Ethereum, Bitcoin, and all that stuff today, which is huge, but they still suffer from a lot of technical challenges. The performance is actually fairly low, right? So Ethereum can do 15 transactions per second. Right. Relatively speaking, if you look at Visa, right, which is Visa is a huge company, right? Visa can do up to 50,000 transactions per second, but Visa is not decentralized, right? It doesn't run on decentralized infrastructure. So what these guys have done is they've built a platform, an algorithm, a technology that can actually, in some ways, the best analogy I can think of is if you watch Silicon Valley, the show on HBO. The Pied Piper, the new internet. So this is what. In real life, what these guys have solved, literally a new consensus algorithm to build a new internet. And it's funny, when I watched the show, I'm like, holy crap, this is so their technology is called Hashgraph. It's called Hashgraph. And I'm like, this is it. So this is one of those funny cases where it's sort of like life imitating art, and so and they have since, so I invested in them a year ago. In the last year, they have since gotten a lot of buzz. So again, the company is called Hashgraph. I've gotten a lot of buzz, and again, they knocked on a number of doors in the beginning, and a lot of them was my introductions, and a lot of people it was hard to understand, right? It took me a couple of weeks to really truly grasp sort of the importance of what they're doing. So anyway. So that's another example. So those are kind of 2 examples. They're sort of very different tenor. So in that example,
what was the stage at which you got involved, or how did the project move?
This was, I think I was, in this case, I think I was the 3rd or the 4th check into the company. I mean, literally, I was so early. There was no lead. They've raised a little bit of angel money before. I just basically say, I like you guys so much. I like your personalities and team and your technology so much that, you guys I will help you find a lead, and you guys will be able to find a lead. But, I'll write my check now. I'm just I'm not going to wait because I think you guys are doing something really interesting. So for them, it's very early, right? So for them, it's literally 2 guys with a white paper and some code, and that was it.
Excellent. What's very inspiring listening to you for this community is that we constantly these days see investors, including angel investors and these micro VC funds, who are all wanting to come in after there is validation and many after there is some traction. So there's business model validation, there's clearly a product in place, there are customers who are buying it, and blah, blah, blah. And when you're developing complex technology and especially making some very serious technological breakthroughs like the kinds you're describing, the 2 examples you gave are like hardcore technology areas, it's not so easy to get to check all those boxes before going out to raise financing. You need financing to get to those checkpoints. And it's very nice to see that you're working on in those phases.
Yeah, so what I tell these guys, by the way, when I kind of do the check before the lead comes in, so the one thing I do ask them to promise me, and I do kind of sit down with them to make sure that we do agree on it, is to make sure that whatever their financing plan, it is well capitalized. And I've made plenty of investment mistakes where I would write the check, and it turns out they ended up undercapitalizing, right? So they don't have enough runway to get to the milestones for the next round. So what ended up happening was that whatever money they raised in that round it just gets wasted. They couldn't raise the next round. They have to shut down. They have to shut the company, right? So a lot of these, I mean, these are like things that you learn early on, you know, in angel investing, the mistakes you make, right? So one of the things I always tell these guys early on is like, guys, let's work through your financing plan, and let's look at your product milestone, your customer, whatever milestone that might be that allows you to raise the next round. You know, it's very simple. Let's work backwards, right? Let's work backwards, how much money you need, what's your burn, and then let's just add 6 months of buffer for seasonality and whatever, and then that's the amount that you need to raise. And for me to write a check now, I need you to promise me and look me in the eye that this is the amount you're gonna raise.
Yeah, and especially, you know, we kind of, in our methodology, we differentiate between lean startups and fat startups. There are certain companies that can be built as lean startups, and that can get to validation, traction, adoption quickly, and with small amounts of capital. And there are all sorts of bootstrapping techniques that we are using. We were earlier, before you came on the line, there was a presentation from Ram Ramdas, who actually has a question for you in public chat, who presented a very interesting fintech company in India that actually took a first customer in for a couple of $100,000, about $300,000 of upfront license fee payments and plus maintenance, which allowed them to basically use that as seed money. That's fine. Those kinds of strategies for bootstrapping are fine, but if you're going the route of raising money from investors, and if you don't capitalize it enough in a fast startup scenario, that is a recipe for disaster.
Yeah, exactly.
So you have a couple of questions from the audience, Waikit. One is, I think actually Ram Ramdas is asking you, do you invest in Indian startups focused on solving problems in the Indian market, but related to your domains of interest?
Yeah, no, short answer is I don't. And the reason is, I mean, I find that, you know, startups in different countries, I think startups in different countries are very different, right? I think you even see the differences between, you know, startups in the West Coast in Silicon Valley versus startups, you know, if you're building a startup in, you know, the Southeast, right? And they kind of take on very different tenor and cultural differences. Not that one is better, one type is better than another, but it's just that even with that, I sometimes kind of struggle with like understanding sort of, you know, their way of doing things. Yeah, with international startups, number one, I can't be as helpful, you know, beyond the check. I think number two is I just don't really understand the cadence, right? So I don't. So I generally just kind of,
So Ram, just an adjoinder to Waikit's feedback, there are very specific investors, both angel investors as well as micro VCs and VCs who will invest in Indian startups. So we have all those contacts. So as long as you're working within the 1 million by 1 million framework, we will introduce you to the right people. Waikit, the next question you have is from Jimish Shah, and he's asking, my question for you is, how do you find the right team when you just have an idea? And I think Jimish is asking this question from an entrepreneur's point of view. So if you could answer him with your entrepreneur hat on, that would be great.
Yeah, that's the $64,000 question. That was a $6.5 million question, right? I mean, I think team formation, forget team formation. I think how do you find your co-founders, right?
Yeah.
I think that's the hardest thing. You know, this is where I think, you know, sometimes if you want to do something, you want to start a company with an idea, you have to be thoughtful, right? I generally do not recommend people doing it alone. I mean, unless you're kind of like jack of all trades and you can kind of deal with the ups and downs, and there's a lot of emotional ups and downs. And it's good to have another person to kind of bounce things off of. So I think my advice to entrepreneurs is always that, whether you're a tech guy or a business guy, find your soulmate in some ways, right, in business, right? If you're a business guy, find your counterpart on the tech side. Or if you're a tech guy, find your counterpart on the business, right? I think to me, sometimes you just need, one other co-founder, and that's it. It's a founding team. Sometimes you need two, depending on the types of project and complexity. But I think a lot of this is making sure that, you mind your past network. I think this is where your past experience comes into play, right? Like who you have worked well with, that you can rely on, that you kind of have a very similar mindset and value system. I think that's really important. I think that two reasons why startups don't make it, right? Number one, they run out of money. And I think number two, the founders give up. And a lot of times, the root of founders giving up is just the founders don't get along, right? So I think that's really important. I mean, especially you're going to spend more time with your co-founder than your spouse, likely. So, so I think it's non-deterministic. I would say invest time, going out, network, meet people. Don't jump into bed super early. If you find someone that you're excited about, maybe spend a few months just working with them and see how that pans out before you split equity or whatever, right? I think it's important to just kind of test things out and have a honeymoon period.
So again, I will make one comment based on what you said, Waikit, on this topic. We are seeing a very big uptick in solo founders getting to $1 million in revenue right now. And it's typically not the kinds of companies that you described in your portfolio, this very heavy technology company, and these are not the fat startup style of companies. These would tend to be coming from the lean startup area, but it's an unusually prolific time for solo entrepreneurs as well, and with very little money and using a bunch of freelancers, offshore resources, and so forth, you can actually put together companies these days that will get you to $1 million a year and
Absolutely.
beyond. I mean, it's unusual, really interesting what's happening. One of our case studies that I've always loved, and I found it inspiring myself, is a company called Fine Art America, and you can go look at it on the blog. It's a company that had just 3 people, and they were doing $5 million a year, which is unbelievable level of scaling with very, very economic.
These are my favorite kind of companies. These are my favorite kind. So this is what I tell people, right? This is what I tell people, right, guys? Like this whole idea of raising money, and it's like that shouldn't be your first choice. The best kind of financing is from your customers, right?
Customers, absolutely.
Why do you want to sell pieces of your company if you don't have to, right? I'll give you another example along that line, right? Like there's so many open source software today that you can scale, you can build a lot of stuff just with a very limited number of people, right? Maybe even one person, right? This is my favorite case study. There's a company called Built With. It's out of Australia. It's by a gentleman called Gary Brewer, and to me, he's sort of like the extreme classical case. One guy built this business over a period of 10 years. I believe his run rate right now is about 12 million a year.
There you go. Wow.
There you go. Yep. One guy, and I think he's got half a person in London that does content marketing, that blogs and stuff like that. That's it. And my guess is that like his stuff is so automated. I think he works like 4 hours a day. That's it.
Yeah,
right? You don't need investors. You don't. This is sort of like, to me, once you get a company to that stage, that's the ideal makeup, right? Because then, if you wanted to raise money, you control all the cards. You want to raise money at a higher valuation to kind of blow this up, you can do that. But if you want to keep it a lifestyle business that just, spews off cash, you can do that too.
Right. And in the 1 million by 1 million program, we are actually completely inclusive of those companies that want to build bootstrapped and to those even solo entrepreneurs getting to $1 million, $2 million, $5 million kind of range. You don't have to go from 0 to 100 million in 5 to 7 years, which is what VCs are looking for, but you can, build businesses, successful businesses, other ways